To understand global corporate taxation, you need to understand the friction between two systems: residence-based taxation, which taxes an entity on its worldwide income, and source-based taxation, which targets income exactly where the economic activity occurs. If a jurisdiction wants to apply source-based taxation to a non-resident's business profits, it has to prove that the entity has a permanent establishment, or PE, inside its borders. In the United Arab Emirates, the strict legal threshold for that tax liability is codified in Federal Decree-Law No. 47 of 2022, specifically Article 14. The UAE designed this framework directly on the internationally recognized principles of the OECD Model Tax Convention. A common misconception is that a permanent establishment requires a formal branch registration or a signed physical office lease. In reality, UAE PE status is triggered by a highly precise matrix measuring physical placement, disposal rights, economic agency, and specific temporal thresholds. Misunderstanding this matrix exposes a multinational enterprise's global profits to entirely new, unintended tax liabilities. The first major category of tax nexus is the fixed place PE. This grid breaks down the four strict variables required to trigger it: place, permanence, disposal, and core business activity. The place and permanence tests require a specific geographical location and commercial coherence over time. The location doesn't even need to be affixed to the ground. A floating restaurant suspended by a hot air balloon establishes a distinct geographic link. Next is the dispensal test. The foreign enterprise must have a legal right, domain, or continuous control over a space. We can test this with a common scenario: a non-resident working from a home office in the UAE. If an employee optionally works from their apartment, that incidental use does not satisfy the disposal requirement. The equation flips if the foreign employer mandates the use of that home office, bears the costs associated with it, or holds a formal legal right to access the space. A fixed place PE is defined by the enterprise's continuous legal operational control over a location, regardless of where personnel happen to sit. Moving from physical boundaries to temporal ones, the UAE applies a strict 6-month threshold for building, construction, or installation projects. Historically, multinational groups tried to bypass this time limit by artificially splitting massive contracts into smaller phases, assigning each to a different subsidiary. This chart illustrates how Article 14 shuts down that strategy using the anti-fragmentation rule, derived from the OECD's BEPS Action Plan 7. Consider Company N, a foreign entity awarded a 9-month modular building contract in the UAE. Company N executes the first phase of the contract for fabrication, which takes exactly 5 months. The second phase, assembly, is executed by a related sister company, Company M, lasting 4 months. The enterprise assumes that because neither entity crossed the 6-month mark, neither triggered a permanent establishment. But the UAE tax law legally reconstructs the timeline. It aggregates commercially coherent, connected activities performed by related parties on the same project. By combining the time spent on both phases, the total exceeds 6 months. The UAE recognizes a single cohesive operation, triggering a permanent establishment for both Company N and Company M. The law actively pieces the supply chains back together to assess the tax reality, neutralizing fragmented corporate structures. Under Article 14, Clause 5, a foreign entity can trigger tax liability with zero physical footprint. This diagram outlines the agency PE. It triggers when a dependent person habitually exercises authority to conduct business on behalf of a non-resident. The legal trigger here is habitual negotiation. If a local agent negotiates the core elements of a contract that the principal routinely accepts without modification, a PE is formed, even if the foreign company formally signs the document elsewhere. Take the case of Company D, an international clothing manufacturer operating through a commissionaire arrangement. A UAE agent sells Company D's goods to local customers in their own name, issuing local invoices. Company D retains legal title to the products until they reach the customer. Because the agent acts as a representative negotiating sales, their activity creates an agency PE. We contrast this with an independent agent, protected under Article 14, Clause 6. Consider a foreign pharmaceutical company that hires local marketing representatives in the UAE. These representatives actively promote medicines to doctors. because they lack the authority to negotiate prices or conclude contracts, they do not trigger a PE. The true locus of contract negotiation determines economic tax exposure. Securing your tax position requires strict audits of exactly what local representatives are allowed to say and do. This map illustrates the specific safe harbors the UAE tax law provides to protect its status as a global logistical and financial hub.
Article 14, Clause 3 exempts activities of a strictly preparatory or auxiliary nature. For example, maintaining a massive facility strictly for the storage or display of goods does not constitute a permanent establishment. However, if you upgrade that same warehouse to actively process online sales and distribute goods directly to customers, the operation becomes a core income-generating activity. The exemption breaks and a PE is triggered. The most critical financial safe harbor sits in Article 15, the Investment Manager Exemption. This allows UAE-based professionals to manage foreign wealth, provided the manager is subject to regulatory oversight, operates independently, and receives compensation on an arm's-length basis. Under these conditions, foreign investors can trade commodities, equities, and even crypto assets through local managers, without ever triggering a PE. Additionally, if an enterprise's home country holds a double taxation avoidance agreement with the UAE, the terms of that treaty will override domestic law anywhere they conflict. Determining a permanent establishment depends on a forensic analysis of how a business actually functions on the ground. For multinational enterprises operating in the UAE, legal form no longer shields operational substance. True tax exposure is dictated by the reality of disposal, aggregated timelines, and the economic authority of local agents.